We've all seen that number hit our bank account, right?
Yeah.
But how much do we really understand about what goes into it?
Yeah, it's more than just the final figure.
Exactly. And maybe more importantly, what other payments, beyond that regular paycheck actually count as income.
Hmm.
Today, we're peeling back the layers on your earnings, everything from your salary to those unexpected bonuses, maybe even payments for like casual work around the house.
Okay.
Our mission in this deep dive is to give you the insider track on wages, salaries, and other earnings. We've got a curated stack of resources to cut through the complexity, especially helpful as we head into tax season.
Definitely.
And we're looking at the latest updates for 2024 just to make sure you're well informed.
And that well-informed part is really critical. It's honestly surprising how many different ways compensation can come our way.
Right.
And each one, well, it can have pretty distinct rules. This isn't just about ticking boxes on tax forms,
No, it's bigger than that.
Yeah, it really is. It's about truly grasping the landscape of your income, how it's defined, how it's treated. Understanding these nuances can genuinely, prevent headaches down the line, help you plan your finances better, and just give you a clearer picture of your own financial world.
Okay, let's kick off with some crucial updates then. For 2024, these directly impact your financial planning.
Good place to start.
So for those of you diligently contributing to retirement plans, there's actually some good news on the deferred compensation front. You can stash way more for your future.
Exactly. And that's significant. The total annual contribution limit for plans like your 401k, 403b, the federal government's thrift savings plan, and most Section 457 plans, it's increased
To what?
to $23,000, which is, a great opportunity to boost those retirement savings.
23,000. And for those aged 50 or older, it's even better, right?
That's right. You get those special catch-up contributions, allowing you to put away up to $30,500 for 2024.
Wow, 3,500. So these annual adjustments are pretty vital then.
Oh, absolutely. Reviewing your contribution levels now can really improve your long-term financial health. And bonus, maybe even reduce your current tax liability.
So it's kind of an immediate win if you can take advantage of it?
It really is.
Yeah.
And beyond retirement, there's another key update for 2024. This affects many of us managing healthcare costs, health flexible spending arrangements, health FSAs.
Right, FSAs, yeah.
The limit on how much you can voluntarily reduce your salary to contribute to one of those, it's now $3,200.
$3,200. Okay, another important figure to keep in mind for budgeting healthcare stuff.
Exactly.
Okay, so we've covered some, forward-looking planning numbers. Now let's get to the bedrock, the foundation of employee compensation for most people. The Form W-2.
Ah, the W-2.
Yeah.
Familiar territory for many.
Yeah, most of us get one. Typically shows the pay you receive for your services, and you include that on your Form 1040 or 1040-SR. Seems pretty straightforward, right?
It does seem that way. But here's where it gets interesting. Not everyone actually gets a W-2.
Oh.
Even if they're clearly doing work that, feels like employment.
Really? Who would that apply to? I kind of thought if you work, you get a W-2. End of story.
Not always. For instance, if you perform household work, so work in someone's home,
Okay.
your employer isn't required to give you a Form W-2 if you earn less than $2,700 in cash wages during the calendar year.
$2,700 cash, okay?
And if no federal income taxes were withheld from your pay, both conditions have to be met.
Wow, that's a specific threshold. So we're talking about roles like babysitters,
Yeah.
house cleaners, nannies, maybe private nurses, yard workers, that kind of
Exactly, those kinds of roles, yes.
So what does this mean for you if you're in one of these situations and you don't get a W-2?
Yeah.
Or, flip side, if you're the one hiring someone for household work?
Well, it means you still have obligations. If you're the household worker and your employer didn't withhold Social Security and Medicare taxes, those FICA taxes, you're generally responsible for paying those yourself. You typically file Form 8999 uncollected Social Security and Medicare tax on wages with your tax return.
Form 8919.
Got it. And it's crucial not to overlook this because those wages are still taxable income. Whether you get a W-2 or not, it's still income you have to report.
So even for, occasional babysitting for relatives, that income counts.
It does.
And if I hire a babysitter, I might have responsibilities here too.
Absolutely. The pay for childcare providers and babysitters must be included in their income. Now, if they're not technically employees, meaning you, as the payer, don't control how they do the work, just what result you want.
Right, like an independent contractor kind of relationship.
Exactly. Then they're likely self-employed. In that case, they'd report their income on Schedule C, Form 1040, profit or loss from business.
Schedule C.
And yes, those rules apply even to occasional babysitting. It doesn't matter if it's family or not. And something else, both employees and self-employed individuals' income could be subject to self-employment tax. That covers the Social Security and Medicare for independent workers. It's a detail many people miss.
Okay, that definitely clarifies the foundational W-2 world and its interesting exceptions. Now let's move beyond the regular biweekly pay. Let's dive into the more varied world of miscellaneous compensation.
Ah, the fun stuff.
Yeah. These are the payments that can often surprise us, right?
Yeah.
Either by being taxable when we didn't expect, or, having special rules we really need to know.
A great example is advance commissions or other advance earnings.
Okay.
If you're a cash method taxpayer, which is most individuals, meaning you report income in the year you actually receive it.
Right, when the money hits your hand, basically.
Exactly. You must include these advance amounts in your income in the year you get them, even if you haven't actually performed the services yet.
So if I get an advance on a commission in, say, December, for a sale that actually closes in January, I'm taxed on it in December.
Precisely. In the year you received the cash. Now, there's a little nuance here.
Good.
If you end up having to repay those unearned commissions in the same year you received them...
Right, so deal falls through quickly.
Right. Then you simply reduce the amount you initially included in your income. Easy enough.
Okay.
But if you repay them in a later tax year, say you got the advance in 2024 but repaid it in 2025, it's a different story. You can't just go back and amend 2024. You might be able to deduct the repayment as an itemized deduction on Schedule A for 2025, or maybe even claim a credit, depending on the amount. But it's definitely not as simple as just undoing the original income.
That's a really good distinction to be aware of. Okay. What about bonuses and awards? Everybody loves those, but are they always just simple extra cash tax-wise?
Generally, yeah. If you receive a bonus or an award, whether it's cash goods or services from your employer, you have to include its value in your income. Pretty straightforward.
The key timing thing here is that a promise of a bonus isn't taxable. It's not income until you actually receive it, or until it's made available for you to take, without substantial restrictions.
Okay. Now, this next one seems like it really highlights the IRS's precision. Employee Achievement Awards.
Ah, yes, these have very specific rules.
For those who get recognized at work, there are some rules you should know. You can often exclude the value of tangible personal property from your income.
Tangible personal property, key phrase.
Right. Something physical, not cash, not a gift certificate, not anything equivalent to cash. This exclusion applies to awards for length of service or for safety achievement.
But, and this isn't a blank check, the exclusion is limited.
How so?
It's limited based on your employer's cost for the item, and it's capped. Up to $1,600 per year for what are called qualified plan awards.
Okay, $1,600.
Or $400 per year for non-qualified plan awards. The difference relates to how the employer sets up the award program.
Got it. And there are other conditions, too. The employer has to make the award as part of a meaningful presentation.
Not just slipped into the paycheck.
Exactly. And it shouldn't look like they're just trying to disguise regular pay as an award. The IRS really wants to see genuine recognition here.
So, like, a watch for 10 years of service might be okay. A $500 safety bonus gift card every year? Probably not excludable.
That's the idea. And there are even more conditions where the exclusion doesn't apply, even if it's tangible property.
Oh, like what?
Well, for a length of service award, for instance, if you received it for less than 5 years of service, it won't qualify for exclusion.
Okay. Needs to be significant service.
Right. Or if you received another length of service award that was excludable within the same year or the previous 4 years, they want these to be somewhat rare.
Okay. Limits how often you can get one tax-free.
Exactly. And for safety awards, there are limits too, like if you're a manager, administrator, or a clerical employee, or if more than 10% of eligible employees already got a safety award that year. It's all about preventing it from becoming just regular compensation.
Makes sense. Let's walk through that example you mentioned earlier, just to make it crystal clear.
Okay, good idea. Let's say you received 3 Employee Achievement Awards in 1 year. First, a non-qualified award, let's say a nice watch valued at $250.
Okay, non-qualified, $250.
Then you also received 2 qualified plan awards, maybe a stereo system valued at $1,000.
Stereo, $1,000. Qualified.
And a set of golf clubs valued at $500. also qualified.
Golf clubs, $500. Qualified, got it.
So what's the total value of all the awards?
Let's see, $250 plus $1,000 plus $500. That's $1,750 total value.
Right. Now let's assume each individual award otherwise meets the criteria: tangible property, meaningful presentation, etc. The key here is the annual limit for qualified plan awards. What was that limit?
$1,600.
Yeah.
$1,600.
Exactly. And the total value of your qualified awards, the stereo and golf clubs, is $1,000 plus $500 of $1,500. That's under the $1,600 limit.
Okay.
However, the rules look at the total cost of all property awarded under all plans, qualified and non-qualified, when applying the limits. Since the total value of all awards, $1,750, is more than the $1,600 limit for qualified plans.
Ah, I see. So even though the qualified ones alone are under, the total pushes it over.
Precisely. So you must include the amount over the $1,600 limit in your income. That's $150, $150 total value minus the $1,600 limit. That $150 is taxable income. The non-qualified watch, $250, is also fully taxable because non-qualified awards have their own separate $400 limit and aren't aggregated here for the qualified limit test in this specific way. The example on the source seems to focus on the qualified limit being exceeded by the total value. It really shows how you need to track these things and know those limits.
That's a great example. Thank you. Shows how tricky the details can get. Okay, let's quickly touch on a few other unique compensation types. Severance pay. If your employment ends and you get a severance package.
That one's straightforward, usually. You must include severance pay in your income. Generally, no exceptions there.
Clear enough. What about federal employees? Sometimes they get a lump sum payment for unused annual leave when they retire or resign.
Correct. And that amount is included as wages on their Form W-2, standard procedure.
Okay.
There is a special rule, though. If you resign from one federal agency, get that lump sum payment, but then get reemployed by another federal agency in the same tax year. And because of that reemployment, you have to repay part of that lump sum leave payment.
Right, because you didn't actually separate from service fully.
Exactly. You can reduce your gross wages for that year by the amount you repaid. So you only pay tax on the net amount you kept. But you need to attach proof of repayment, like a receipt, to your tax return. Only works if the repayment happens in the same tax year you received the original lump sum.
Okay, good specific rule for federal folks. Now here's one that I know catches people off guard. Outplacement services.
Ah, yes. This is a common scenario during layoffs.
Right. Let's say you're offered a choice. Option A is your full severance payment, say $10,000. Option B is a reduced severance, maybe $8,000. Plus, the company pays for career services like resume writing, interview coaching, job search help. Many people take option B thinking, great, I get help finding a new job, and it seems like a free benefit.
And this is where a tax principle called constructive receipt often comes into play.
Constructive receipt.
Yeah. The idea is, if you had the choice to receive the higher amount, $10,000 cash in this case, but you chose to receive less cash plus a service instead, the IRS generally treats it as if you received the full $10,000.
Seriously?
Yes, it's like you got the $10,000 and then immediately spent $2,000 of it on those outplacement services. So even if you chose option B, you generally must still include the unreduced amount of severance, pay the full $10,000 in your income for that year.
Wow, that's counterintuitive.
It really is. It underscores the importance of looking at the full financial picture, including tax consequences, not just the immediate perceived benefit. It raises an important question, doesn't it? Are you considering the tax impact before making decisions about your compensation, especially when you have choices like that?
Definitely something to think about.
Oh.
Okay, moving into some even more specific scenarios, let's talk about differential wage payments. What are those?
These are payments an employer makes to an employee who is called up for active duty in the uniformed services, usually for more than 30 days.
Okay.
The payment basically represents all or part of the wages the employee would have received from the employer if they hadn't been called up.
Got it. Like making up the difference between military pay and their regular salary.
Exactly. Now, tax-wise, these are treated as wages. They are subject to income tax withholding.
Okay.
But here's a key distinction. They are not subject to FICA taxes, that's Social Security and Medicare, or FUTA taxes, which is federal unemployment tax.
Okay, so regular income tax applies, but not the payroll taxes.
Correct. And they are reported on the employee's Form W-2. It's an important consideration for our service members and their employers.
Good to know. What about when you're out sick or injured? Does the pay you get then count as income in the same way as your regular salary?
Generally, yes. Pay you receive directly from your employer while you're sick or injured is usually just considered part of your regular salary or wages and is taxed accordingly.
Mm-hmm.
This also extends to sick pay benefits you might receive from other sources like welfare funds, state sickness funds, maybe employer or employee associations, or even insurance companies if your employer paid for the plan or policy.
Okay. If the employer funded it.
Right. But here's the crucial difference. If you personally paid the premiums for an accident or health insurance policy using your own after-tax money,
Uh-huh.
then any benefits you receive under that policy are generally not taxable.
Okay, so who pays the premium is key. That makes a big difference.
A huge difference, yes.
Yeah. Now, here's one that you described earlier as a potential head-scratcher. What if my employer makes an agreement to pay my share of Social Security and Medicare taxes directly? Like, they pay the employer and the employee portion without deducting my share from my gross wages.
Yeah.
Sounds like a fantastic deal, right? Less tax taken out of my pay.
It certainly sounds beneficial on the surface. Who wouldn't want their employer to cover their taxes?
Exactly.
But from the IRS's perspective, when your employer pays your share of these taxes for you, that payment is considered additional compensation to you.
Wait, what? So if my boss pays my share of Social Security, that payment itself becomes more income for me?
That's generally correct. You actually must report the amount of tax paid for you by your employer as taxable wages on your tax return.
Get out of here.
It's true. It's treated as additional wages not only for income tax, but also for figuring your future Social Security and Medicare benefits. There are a few narrow exceptions, mainly for household workers and some farm workers, but for most employees, that employer payment of your tax share is just more taxable income.
That feels so counterintuitive. It feels like a benefit, but it increases my taxable income.
It does, and it really reinforces the idea that even seemingly beneficial arrangements often come with their own tax considerations. It encourages, critical thinking about the true cost or true tax impact of an employer-provided benefit, especially when taxes are absorbed on your behalf.
Wow. Okay. Lesson learned there. Moving on to another potentially complex area, non-qualified deferred compensation plans.
Right. These are arrangements where you agree to receive some of your compensation in a later year. When you initially defer the compensation under these plans, the amount deferred is usually reported on your Form W-2 Box 12, often with code Y. Importantly, it's not included in your taxable income, Box 1. At that point, you get to defer paying tax on it.
Okay, so far so good. Tax deferral.
However, these plans have very strict rules they need to follow under Section 409A of the tax code. If the plan fails to meet those requirements at any point during the year or isn't operated correctly, then the deal is off, essentially. All amounts that have been deferred under the plan and have vested, meaning you have a right to them that haven't been taxed previously, become taxable income in that current year, immediately.
Ouch. So a plan failure can accelerate all that deferred income into one tax year.
Exactly. You'd see this amount suddenly included in your regular wages in Form W-2, Box 1. And it would also be reported in Form W-2, Box 12, but this time with code Z, indicating income under Section 409A. It's a critical compliance point. Big penalties can apply too.
Definitely something for executives or anyone in those plans to be aware of. Okay, finally, let's briefly touch on stock appreciation rights, or SARs. How do these work from an income perspective? Are they like stock options?
They're similar in concept, but work a bit differently. Think of it this way. Instead of getting actual stock, you get the right to a cash payment equal to the increase in the stock's value over a certain period.
Okay, so you benefit from the stock going up, but you get cash, not shares.
That's the typical structure, yes. And in terms of income, you don't include a stock appreciation right granted by your employer in your income when you receive the right. There's no tax event just for getting the SAR. The taxable event happens when you exercise the right. When you do that, you're typically entitled to that cash payment, which is calculated as the fair market value of the company's stock on the exercise date minus the fair market value on the date the SAR was originally granted.
So you get the appreciation in cash.
Right. And that cash payment is included in your income as ordinary wages in the year you exercise the right and receive the cash. It's a way to benefit from stock growth without the complexities of actually owning and selling stock until you decide to cash in.
Got it. So taxed when exercised based on the cash received.
Correct. Yeah.
Wow. Okay. We have truly taken a deep dive today into the many, many facets of wages, salaries, and other earnings.
We really covered a lot of ground.
Yeah, from understanding those crucial 2024 updates on contribution limits to navigating the specifics of W-2s, household employees, employee awards, severance, even sick pay. It's clear that your income can come in many forms,
Mm-hmm.
and each form seems to have its own specific rules and implications.
Absolutely. And if we connect this to the bigger picture, I think the key takeaway is that compensation isn't just about that number on your paycheck stub.
Right.
It's a really dynamic landscape. There are specific rules for almost every type of payment you might receive, from your regular wages to deferred benefits, bonuses, awards, even, income from side gigs or household work.
Yeah.
Being well informed here means not just knowing what you earn, but understanding how it's classified for tax purposes and really grasping what the implications are for you personally.
It empowers you, really.
It does. This knowledge empowers you to ask the right questions, maybe of your employer, maybe of your tax advisor, to plan more effectively and ultimately to take greater control of your financial well-being.
So here's a final thought for you, our listeners, to maybe mull over.
Okay.
With so many different ways to receive income and so many specific, sometimes quirky rules like the ones we've discussed today, are there parts of your current compensation package, or maybe even casual earnings you have, that you've always just taken for granted?
Good question.
Things you might now see in a new light after this deep dive. Perhaps it's time to look again at those fringe benefits, those bonuses, maybe even that casual babysitting money, and just understand the true tax picture behind them.
It pays to look closer sometimes.
It really does. We've just scratched the surface today, of course. There's always more detail. We definitely encourage you to explore further using the actual IRS publications. We touched on concepts often detailed in Pub 525, taxable and non-taxable income, and things like household employees are in Pub 926. These resources and the forms like W-2 or Schedule C are easily found right on the IRS website.
IRS.gov forms is a great starting point.
Definitely. A little research can go a long